How many publicly listed companies are in the market? Exactly. There are tens of thousands. As an investor, how could you possibly look at all of these? Better yet, assess all of them? Assessing all the publicly listed companies that you'll find in the market is just too much work. So, how do you know what's the best company to invest in if you can't assess every company that's in the market? You can actually narrow the list of possible companies that are the best to invest in for you. Now, you must be wondering, how exactly can that be done? All you have to do is to look for specific ratios. You're going to have to pay attention to the data that actually matters to save some time in evaluating these companies. How would you look for an opportunity? Do you ask around your friends or family? Do you get on Google? Or do you go on Twitter to see what other investors are saying to invest in? Not everything that's being bought by everyone is necessarily a good investment for you. What are the things you consider when choosing a company to invest in? You want a company that's stable, preferably has been in the market for a long period of time, a company that continues to grow, is known to have good management, a competitive business. Some of these factors you'll know about in a matter of a few clicks here and there, but some of these factors you'll only be able to get data on in a matter of days or longer. The strategy you can try out is looking at the data you consider important that you can get quickly. If you're able to see the data and it doesn't meet your standards, then the company should be off the list of options. This will save you some time instead of going through all the data you consider for every company. As you narrow down your options, the companies left in your list should be companies that are better than just average choices. Thanks to technology and the digital world we live in now, there are many investment research platforms to help you in your search for a company to invest in. These platforms can help you filter data for the companies you want to assess and analyze these. Let's go through the steps of the strategy for us to better understand how we can apply this. First, you want to evaluate. Do you want to buy a Lamborghini? You can't answer that since you don't exactly know how much we're talking. You can't be ignorant about how much you're paying for something. A stock isn't your way to millions of money. It's a share of a company. So you have to ask yourself, how much exactly is the cost of the stock of that company? So one filter you should think of is the prices of the stocks. First, you want to filter the countries you can invest in because there's no point in assessing companies you can't buy stocks of. Second, you need to filter out the sectors you don't invest in because you don't want to invest in a sector that you know nothing about. Third, you'll need to filter the companies by stock price. You don't want your cost to be more than your earnings, obviously, or that just wouldn't be profitable for you at all. If you filter out based on the stock prices of companies, then naturally, you'll miss out on some companies, but at least it's less probable that you make mistakes in spending too much and earning less. After you filter out whatever else you need based on your own preferences, you'll be able to assess the companies that are left on your list that reach most of your standards. A company that doesn't have a costly stock price is a good place to start. Although, you still need to choose one where you can get the highest possible earnings or at least stable earnings. A company that has a high return on assets is usually one that is successful, which means you can get higher dividends. Here's an example to better understand the concept. Say that Lucy owns a clothing store that she paid $2 million for that earns $200,000 a year. Then you have Bianca, who also owns a clothing store but paid $4 million for which also earns $200,000 annually. Which would you invest in? It's a no-brainer that you should go for Lucy because she has 10% return on assets while Bianca only has 5%. There is no guarantee in the performance of the company, that's for sure. It doesn't mean a company has a lot of success in its history that it will remain to be successful long after, so you'll still have to be wise in the choices you're making. After choosing the companies with a good return asset, your choices are now more narrowed down to the best companies for you to invest in. You'll spend less time now wasting your time assessing companies that aren't a good choice for you. Another thing you want to consider now is growth. Is this company stagnant, on a decline, or is it still progressive? Again, it doesn't necessarily mean that it's a progressive company at present. It will continue to be progressive, but the history of a company is still something good to consider because you're trying to minimize risk. So you should filter out the companies that aren't progressive or are declining. Lastly, you want to check the reliability of the data of the companies that are left on your list. Is the data accurate? Is the data updated? After checking the reliability of the data, that's when you take a deep dive into the companies left on your choices. Learn about these companies, their history, the transactions they make. Do your own research. If you do your own research instead of hopping in the wagon with everyone else, the less mistakes and the less regrets you'll have. That's all for this video, eggheads. Don't forget to leave a comment below. Hit that like button, subscribe, and click that notification bell to be part of our Egghead Finance community. See you in the next video.